Hey, in this video, I'm gonna talk about the basics of the like-kind exchange, which is called 1031 exchange. This is a non-taxable exchange because this is internal revenue code 1031 exchange. Basically, you can defer any gains on doing this exchange. So this video just gonna go through some basics on this exchange. However, for detailed calculation, different cases, different situation, you can find it in other videos. So let's see what is 1031 exchange. First of all, you have to understand it's not you can do exchange. You can change one property to another property. However, you just if it's not like a kind of exchange, you cannot defer the gain. So basically, that's the concept. You always can exchange, but you cannot defer the gain. So here on IRS Publication 551, page 7 say, well, a taxable exchange is one in which the gain is taxable or the losses is deductible. A taxable gain or deductible losses is also known as a recognized gain or losses. If you receive a property in exchange for other property in taxable exchange, the basis of the property you received is usually the fair market value at the time of exchange. A taxable exchange occurs when you receive cash or property not similar or related in use to the property exchange. Here's the example. Say you trade a truck with a adjusted basis $30,000 for a farmland that has a fair market value $60,000. You must report a taxable gain of the $30,000 for the land, and the farmland has a basis of $60,000. In this case, you can see you have to, in the year of exchange, you have to recognize the entire $30,000 this gain, right? This is taxable. However, if you are in a non-taxable exchange, so you can defer that $30,000 gain. So here is non-taxable exchange. Basically, it's a 1031 exchange. So the certain change of the property are not taxable. This means any gain from the exchange is not recognized. Any loss cannot be deducted. Your gain or loss will not be recognized until you sell or otherwise dispose of the property you received. Like a kind of exchange, which is the 1031 exchange, say if you exchange real property you use in your business, hold for investment solely for other business, investment real property of the like kind, you do not recognize the gain or loss from the exchange. So basically tell you now, ever since 2017, the new tax law, you only can do 1031 exchange on the commercial real property. So basically only the real property used in like a rental property you hold in the business. So you can do 1031 exchange. You can defer the gain. You cannot do any other properties. So that's the new law. So amount realized. Say the amount you realized from the sale and exchange is the total of the money you receive plus the fair market value of all the property or service you receive. The amount you realize also include any of your liabilities were assumed by the buyer and any liability to which the property you transfer is subject, such as real estate tax or the mortgage. So basically, when you're calculating, what's your basis realized gain, this type of thing, you have to find out what's your amount realized. So here I have said when you do 1031 exchange, your fair market value of property you received, you have to add any money you received, add any your liability like mortgage assumed by the buyers, then any other taxes was assumed by buyer. That's kind of your realized. Then you minus any money you paid, minus any liability assumed by you. So that will give you amount you realized. So it's a very important concept to understand how to find out the amount you realized, because once you have amount realized, then you minus your basis, you adjust the basis, then you'll get the realized again. This is very important, the number you need to find out in your exchange. So we talk about boot. I didn't find this boot concept in the publication. I don't know if it's written in any, in the code, tax code. So anyway, so this is usually people in the business, they call this boot. So boot is the cash and the assumption of the liability or other property you received during the exchange is knowing the tax law as a boot. So basically any cash if you received or gave up, any liability you assumed or assumed by others is called boot. Why they exist? So because it's very difficult to find a qualifying real property to generate an even exchange trade. Typically cash or other property involved in the exchange to benefit one party to equalize the exchange. Yeah, it's a very difficult say if you want to exchange property 1 million, you have to find exactly the other property is 1 million. So it's very difficult. That's why that was boot. Assumption of liability. So this I talk about in other video in details. So basically you should know for the purpose of figuring out the realized gain, add the liability assumed by other party to your amount realized, subtract any liability of other parties that you assumed from your amount realized. Last thing you want to mention here is like a kind of exchange between related people. So here I just want to highlight it here, say you can related people is like your family. Here I tell you who is related people. Basically if you do a 1031 exchange with the other your family member, then what the rule say is this rule affects both direct and indirect exchange. Under this rule, if either person disposed of the property within 2 years after the exchange is disqualified from the non-recognized treatment. So the gain or the loss original exchange must be recognized as the date of the later disposition. So basically, if you deferred $1 million gain during the exchange, then your family member, either you or the other party, they sell the property within 2 years. Basically, all this deferred gain, you cannot be deferred. You have to recognize the gain right away, right? So that's the punishment to the real related person. Here, there's a little exception. Say the only exception to this treatment are the deaths of the recipient taxpayers involved convention. So let's this example say Carol entered into like a kind of exchange with his father 18 months ago. His father is just died. Carol is free to sell the property he received in the exchange because the death is an exception of the 2-year rule related to the partylike kind of exchange. Yeah, that's something good to know here.